This is last year's annual report. So I will wait for the annual report to come out for this year, which will likely be in August, and then I will analyze that. But for now, I'm not going to go through the entire report. I only want to check the notes here. So that is on page 142. So see, we have the balance sheet. This is for last year, and then we have cash flow statements. There is repayment of lease liability, including finance cost. So they haven't given any notes for this. So this added the finance cost here and then subtracted again from here. This makes no sense. You know who's making money? The guy who owns the property for the store and has leased it out to the company. They are earning rent. Inventory, trade, all of these numbers are there. All of this is fine. So let's take a look. High amount of their overall current asset, total non-current asset, is this right of use asset, which is lease properties. Before that, let's come to the income statement. They have their revenue, they have cost of material, stock in trade, all of these, employee expense, benefit, finance cost. This is 36. Then they have 37, and then they have 38 other expenses. So let's take a look at this note 36, 37, and 38 to see if they have included their lease payments somewhere here, because they are adding back this depreciation and amortization in the cash flow statement. Here they are adding back depreciation and amortization and this finance cost. So the notes number 36, 37, 38. 6, 37, 38. 36 is the finance cost, which is interest on this lease liability. Oh my, oh my god. Repayment of interest on lease liability. This is for last year 2.5 and 4.2, right? 2.5 and 4.2. Okay, okay, okay. So in 36, they have interest on working capital loans, other interest. So they made a profit. What happened to that cash? Did they pay it out to the investor or did they invested it back in the company? Nope. So there is interest on lease liability. I look at the annual report 2.593. And then amortization is depreciation on property, plants, equipment. This is true depreciation. And then depreciation on rights of use assets. Okay, thank God. Thank God at least they have shown that in depreciation. So I come back to the balance sheet. They had non-current liability which was very high, and then they had this lease liability which was 466 million, and here they have paid this 466 in a way as depreciation. So their total depreciation is this. And if you look at the other expenses, they have consumption of consumables, job work charges, electricity, fuel expenses, lease, rent. Refer to note number 55. Once again, check that. Repair and maintenance, insurance, all of these, social, traveling, conveyance, printing, commissions for what? So there are so many other expenses. Advertisement and publicity expenses. So all of these other expenses are there. That is true. Take a look at this. So this other expenses is fine. It doesn't include much of lease part. The lease part is restricted to these two. There's finance cost, which is interest on lease liability. They have a lease liability and they pay interest on that, and then they depreciate right of use assets. So that rent is shown as depreciation, right? So the total payment that would be 461 and 260 and 460 would be 526 27 20, and that part is here and here. So they have the rent taken care of, but then when you go back to the if you go back to the income statement, where is the rent, you may ask? That is here. Finance cost and depreciation and amortization is actually rent payment. They don't have debt, as in they have not taken loans, so they are not paying any interest for that. What they have is lease liability, and a certain portion of that is paid as uh, interest, because that has been financialized. The lease has been financialized, and then they depreciate the right of use assets and pay the money out. But where do they pay the money out? So they have their cash flow. They haven't paid this money out here. And if you subtract this 6.8 from this operating activity, you are left with 6, and then they have their capital expenditure here. Similarly, this is for previous year, that is for year ended 2023. The net cash from operations was 7.5 751 million, and their lease payment was 585. Hmm. So if you subtract this, they are hardly left with anything. It's only 1.7. So where did they got remaining 1.7 here? They didn't. The cash went down. It's a weird phase. So if their profit was this 622, 672 million and 622 million, what did they do with the profit? They had high capex. Everything went in capex. So if their capex wouldn't be so high, right? If you compare the capex to net income, it's really high. I think the company is selling for too much. It's not as cheap as it looks in the beginning, and that is a key point. The company is too expensive. If the market cap of the company falls down to pre-existing levels, if the market cap of the company falls to pre-existing levels, then it may or may not be a good buy. But right now it seems too expensive, because what is this capex? They have not given any notes for this. So this depreciation does include rent, but then of the profit they make here, which was 622 million, they ended up spending 555 of that, 555 of 622 as capex. So subtract 555.622, you have 45 and 22, 77 left, and they paid 74 of that as dividend. So that where the money is going. Most of the money is going in capex. So is your dividends going up? Well, it has gone up for the last 5 years, but it's such a small amount. The dividend yield is 0.38, that even if it goes up 10%, it will only be giving 3.8%. And I'm talking about 10 times increase. That will be another 10 years, 5 to 10 years. And then double of that would be 7%, which I'm getting in Coal India. So it's a company to keep an eye on. For me, I will keep an eye on this company. But it was a good exercise in going through the financial statements to reveal what is actually going on in the company. I think if you compare with, so the problem with this free cash flow is it's not as free. You have to subtract the lease payment. So you cannot subtract this 800 million, at least 466. Let's say round figure 500 million of that is lease payment. If you subtract 500 million from here, this will break it in half and it will become 6 rupees of annual actual profit. So of those 500 million, they are giving 83 million as dividend, and the remaining thing goes into capex. Will they be able to grow the company? That is the point. So we have to wait for the annual report to come out to get this data from the company again. Increase or decrease in cash flow. While last year they had 366 million rupees increase, this year they had about 101 million rupees going down. So the only thing to look at here is, will their sales increase? I think if it comes down, if if the market cap of the company comes down, obviously it will be a good buy. But how much down? If it falls by 90%, and let's say I'm getting it at 26 rupees per share, that would be a good buy. If the free cash flow is actually 6 rupees and I'm getting the company for 26, that would be a good buy. But I think right now it's too much for this company. Then let's go back to the, so they have their right of use assets at number 5, and current assets they have inventory, financial assets. Let's look at number 5. So they just appreciated this. So lease payment is included in the depreciation part, so that's all right. But the income they are getting is all going out in capex. That is also good. So here, so when I look at this free cash flow of the company, uh, here it's given as a billion rupees. That is not true. What they are doing here is they have taken this cash from operations and subtracted the capital expenditure. But this cash from operations also include this depreciation part, which from which we have to subtract this repayment of lease liability and repayment of interest on lease liability, as they have added both of those back. So what we have to do is, we have this 1.5 billion cash from operating activities. Then we have to subtract this, say, 500 million of capex. So we are left with a billion of free cash flow. But from that, we have to subtract this 800 million of lease liability payments. Then you are left with only 200 million. A million is 10 lakhs, crore, 10 crore, so only 20 crore. So the company which is selling for 2000 crore is earning 20 crores, into 10 is 200 crores. So it the real P value is actually 100, not 30. So here, so if you subtract 800 million from the billion, so what we are actually left with is only 200 million of profit, and that is the real free cash flow, not this number suggesting a billion rupees. It's only 200. So the P ratio in that terms, if you consider free cash flow as profit, would be 100 in this case. It's much lesser than what actually meets the eye. So that's all for this video. Thanks for watching.